um, generally good across the big names. Um, a little bit of mix with different asset classes, and it looks like macro struggled a little bit, but the big quant shops did pretty well, up to 3%. um and it seems like the markets are continuing all clear, although today we saw a whipsaw. The S&P rallied early and then looks like it fell off a cliff around 10:30, 11 o'clock or something. And I'll let Mark fill in some of the color around the latest on tariff news. But that's the market we're in right now. It's a headline driven um, risk on, risk off rally that's, based on words that come out of the president's mouth or Besant or, and, potentially Xi Jinping and, out of China. So with that, I will give it off to Mark to talk about the market scorecard.
Yeah, thanks, Bill. Yeah, and it is absolute whipsaw out there. And just to let you know what these tariff talks are doing and why what we say is it's not in the data. And Bill, remind me to bring up later on with the crew here, a couple things about, what we're doing internally and where staff is going, but also what happened with AI and that wacky exchange I had Monday night during the Knicks game, which leads me to my point here. Markets are down. Now, the reason why I saw that is because I now subscribe to the South China Morning Post, just to let you guys know. I don't know if you guys get that on your doorstep, but I get it in my inbox now because they're actually providing headlines. And some of the headlines are not coming over in our press. And when you saw that pop in today's markets, it was based on U.S. news that, Besson says, cautiously optimistic. We have, we're speaking with Chinese trade authorities, I think the 7th or the 8th to the 10th. Don't get ahead of yourself, but it was cautiously optimistic. Markets reversed from like a 50 basis point decline to a rise. But that reversed when out of the South China comes, hey, China warns U.S., don't try to bully us. And we're really not going to move off our area of negotiation. So it went right back down on that headline. So the point is, it's all headline driven. It's why we try to be first principles based and data first, which is why we're going to be showing you our slides right now. As soon as I pull them up on my fancy pants computer here that has a couple screens.
And Mark, while you do that, I did want to ask, is your new publication sort of like Chinese Pravda, or, do you notice a slant toward, Chinese policy? Or
I'm absolutely sympathetic to the land of the rising sun next door. So both Japan and China. Once you start reading, they kind of woo you in, Bill. I mean, think of the title, South China Morning Post. I mean, what's more welcoming than that title? So yeah, I suggest everyone should get that in their inbox. But obviously, buyer beware.
So as usual, I'm going to have to compare you to a character from a movie. If you've never seen Volunteers, I highly recommend it. John Candy gets lost in the jungle for a little while and comes back a commie.
Well, with enough, as they said in another John Candy movie, no, but willing to learn in Stripes. So pretty sure that was John Candy.
It's another classic that I probably saw when I was about 6.
Beautiful movie. One of the better ones. Okay. Let's get this baby going. I got to move it over here, move you over here and put it up. So we had a lot of tumult in markets. So let me share my screen. And Connor, I want you to kind of get ready to push back. Tell me what you see in the digital asset realm versus what we saw on the broader digital traditional assets on a year-to-date basis to see if there's any factor patterns that are complementary and the like. All right, there we go. Let's see what happens when we get full screen here. Okay. So here is the screen I want to start with. It's a scorecard. It is a rank order by returns across major assets. And I did it in 3 segments to do a little, red light, green light, 1, 2, 3. And, this is the land of haves and have-nots. One of the major takeaways in early April was, oh my God, what's happening between the US dollar and yields? They're diverging for the first time. And then now, if you pick your head up, one of the persistent trends is how can US equities be down and German equities essentially zero growth to negative birth replacement? Why is their equity market up 16% and their natively denominated ETF, EWG, which has exposure, up 27% because the euro's up about 10%. So here you go. If you bought EWG at the beginning of the year, Bob's your uncle, you're up as much as gold was last year. And gold is up more than it was last year. Those are the winners, and the losers are everything dollar. So the thematic here is, even though Scott Bessent is an adult in the room, and everyone thinks that, there's not a more credible person. I think there's not a more credible person you could have in the role right now. Thank God Howard Lutnick has taken hopefully a seat in the way back of the negotiation station wagon, so he can't be heard from because he was not helpful. But even with him, we think that what Trump has done has spoiled growth in markets for at least a year. And what we instead focus on, instead of is a dollar going to go up, and is German equities going to continue to go, to revert back down to its, 1% 15-year annualized compound rate, we focus on the middle. So the middle looking at here is, will treasuries continue to languish in the face of one of the biggest, as Bill just said, rallies in 20 years, and also one of the biggest ATRs. I don't know if you use that in your digital asset area, Connor, average true range. It's more of a commodity term. I don't know if that's something that...
It's not something that we at Truvius specifically look at, but I'm sure that other investors do for crypto.
And where's your experience been with people using that? Because I agree, I first heard it at a long short shop with a guy who had a commodities background. But I don't know if you want to explain, or you want to throw it back to me about what average true range is and why people pulled it out.
Yeah, you might be better at explaining it than I do. My level is my understanding is pretty high level, just as like a technical, indicator, price indicator.
Exactly.
Yeah,
and that's exactly what it is. It's used more by commodity folks because it takes in not just intraday, but the open and close. So it looks at the range of a stock over an entire period of 24 hours so that you don't lose it on the open or close where most of the gains are. And the point is that the April average true range on daily moves was beyond anything we've seen in decades. So we're not looking at the, and my point is, despite all this turbulence, the 10-year was not really a safe haven. It was down in parts of it. It's only up 3.5%, and that includes coupon, through May 6th. But Bitcoin has moved from being a high beta to equities, which means it should be down. It should be down along with oil. If people, if it followed the script of past times, it's not. So we think focusing on that middle area, that area, that's the transition. We think treasuries will continue to languish and be a soft haven at best, and that Bitcoin between last night and today is actually it's up. It's up more than the 10-year treasury right now if we were to go with live pricing. So the scorecard for us is not looking at the tails, but it's looking at the middle and what hasn't sprung yet. And we think that treasuries are going to continue to languish because the debt load that's going to come once the treasury lifts its the debt ceiling, it'll be just like March 2023, where for 3 months till June, it was flat in issuance, and then it's going to go right back up again. So we expect a 38 trillion to 39 trillion by the end of the year. And you know, what does that mean? It means more of the debt, probably less buyers, given what we're doing with tariffs. And then here's just our look at where we are on a month-to-date basis. As Bill said, kind of flattish, following April's rebound off that April 7th low. But on a year-to-date basis, you still have NASDAQ down 8%, oil down, speaking of, pointing to recession, and gold absolutely the leader of the pack on a year-to-date basis. So I would say that markets are still absolutely headline-based, which is why we have this podcast, because if you are using yesterday's playbook and saying, I need to be only in equities without understanding what's going on in the macro framework, deficit spending by Germany, the only reason German equities are up is because they removed the debt brake, which was a limit on the amount of deficit spending they could do. They're flooding with over $1 trillion of spending on infrastructure and military. We joke that it's like 1999, but really for Germany, it's like 1939, which really isn't a good sign on military spend by the major economy in Europe. So that's what's going on. A lot of tumult, but we think back to you, Bill, on how you want to set up Connor on how do you risk manage this? Do you risk manage this as a digital asset manager? What's different from your time at AQR? So I know, Bill, you're better positioned there to speak to Connor since you guys work together.
Yeah, and normally I'd love to talk about this chart more too. Even equities were up 24% and through 2024, and then you see a year 12 months ago it's like 9%. So there's just a lot of vol in equities, and I'm starting to do this chart that makes Bitcoin's vol look better than equities, to be honest.
Yep.
And I know that's preaching to the choir with you crypto guys, so I'm not going to bother.
Bitcoin and crypto, Bill. We keep talking about this. My peeps in the Bitcoin community are gonna be like, Mark, you're a crypto guy now?
Bitcoin so am I. Like I said, I was wearing a suit to the crypto conference, and in certain circles I didn't feel like I fit in, and then in others I did. So Connor rejoins us. As I said, Connor was an intern at AQR, and this is going back a while now. I felt old by sort of recalling how long ago that was. So I left AQR in end of 2015, and Connor stayed on for a few years while I was at 2 Sigma, and then subsequently started Truvius. And I'll let you just reintroduce yourself, Connor.
Yeah, thanks, Bill. That was quite a while back, and thanks, Mark and Chris, for having me as well. But yeah, I spent I think all in, including internships and everything, a little more or less 6 years at AQR, and was both on the macro side of the business, so relative value, market neutral, hedge fund style strategies for global macro, related asset classes, pretty much everything except equities. And then the second half of my time there focused purely on equities. And a lot of what we do at Truvius is sort of rooted in that systematic approach to investing, particularly in the long-only active way that we apply things. The structure of our business is we're an SMA manager, so I could talk more about that when we if and when we get into the tax loss harvesting side of things today, and actually why that works really well in a volatile market, and volatility can be an attractive thing, an attractive input to an investment strategy like tax loss harvesting. But I'll pause there, Bill and Mark, and on the intro side of things, and happy to talk more about where crypto fits into all of this.
Well, we certainly do need to talk about automated tax loss harvesting, and I think it's appropriate to dive in a little bit to the differences between taxes with crypto and equities and traditional finance assets, and how you apply whatever you do. So I'm looking forward to talking to you about that. But my first question was, did you read my paper on alpha generation in crypto?
Of course I did. I think I was the first to that was the research roundup, correct? Of all the different, papers and authors that are out there on systematic or factor driven crypto investing.
Indeed. Yeah, it was a, somewhat traditional literature review where I went and found everything I could, tried to whittle it down to what was most appealing to me, and then ultimately trying to find what is practical to implement. And thank you for reading it. And I was curious if, obviously I think the factor-driven research is what you are doing. Have you found a lot of good research out there to assist you in formulating factor portfolios?
Yeah, I was just going to comment, that area is quite thin, I think still. Like, I don't know what your experience was wrangling up that material, Bill, but when we really were getting into looking to supplement our own research or just see the body of existing factor-driven research out there, this is going a number of years ago now, it was really not much. And I think part of that could be attributable to the asset class being new, but I think a lot of people still sit on alpha as opposed to, writing about it or releasing it as research papers. So I would say it's getting better. Like even Truvius could do a better job of maybe more transparently, distributing some of our research findings instead of just, keeping it preserved in the models. Because like any factor investing approach, knowing about an investment approach or a factor is one thing, but being able to implement it and actually execute it is an entirely different barrier to entry. So I'd say it's been a mixed bag where the research to me still feels pretty thin. And what we see out there is even a little bit dated, like a research paper from 2018 is completely obsolete or could be, close to obsolete unless it's dealing with something that's a little more evergreen, like price momentum. But like the factor analysis or blockchain level factors, adoption level factors, things like usage and TVL and how those things relate to each other, that changes pretty frequently.
Isn't that good for you though, Connor? And you're right, TVL is like, having a very fluid, deposit pile at a bank, which banks certainly don't want. But I guess, so, and I bring up asymmetry. When you say it's not a lot out there, I have to think that would mean opportunity. I mean, the burden's on you to find it and to validate it. But totally. How do you weigh those two things of access to credible data versus it being the, home run alpha opportunity?
Yeah. And I everything that exists in between those is having a good research and testing process. So, starting from source data and really starting from like first level principles or priors about you have an economic idea about something that should work, and then you test that hypothesis, and that's using the input data. So if I have a hypothesis that crypto assets with strong TVL and relatively low market cap should outperform assets with low TVL and bloated market caps, I can do things like backtest or just do sort of out of sample testing. That's more linear kind of regression style, econometric style testing. More and more, and Bill, this is probably getting into your world a bit, we are starting to look at non-linear testing, so using sort of ML or AI-driven techniques to look at non-linear relationships between assets, and how those inform expected returns and that sort of thing. But I guess that's sort of a fancier, mealy-mouthed way of saying it's a lot of elbow grease and it's a lot of work to, you have to stand up a process to first ingest data, know what kind of data you want to look at, and then you run through, essentially a playbook of research steps and testing. We find a lot of stuff, by the way, that doesn't work. We look at a ton of things that have no at least as far as we can tell, don't have informative value or predictive value, and we that's something too. And even just apart from the factor side of what we do, when we see blockchain data and we test whether it has predictive power, there's also a lot of work that goes into the implementation of it. So let's say you have a signal you think works. How do you actually trade it? How often should you rebalance it? Which assets does it work for? Which assets doesn't it work for? Does it decay over time? Is it losing predictive power? Is it gaining predictive power? So there's the factor discovery side of things, and then there's the implementation side of things that we also spend a lot of time on. So it's a big gulf. There are a lot of players moving more and more into this space, the factor active management space, but we do think it provides a lot of alpha, and we see it, in some of our outperformance for our products. And that's something we just continue to iterate on.
Cool. Well, I guess just to recap a little bit, I think the transparency around factor investing is something that was very big, at our former employer. AQR is sort of a trendsetter with sharing the full detail behind the strategies they implement. The downside, of course, is people can use it as a roadmap to replicate what you're doing. And if it is arbitrage, true alpha, that might be problematic. So my last employer was sort of the opposite of that, and I think that that's typically the way quants are, secretive because of the fact that known alphas are arbitraged away. And I believe that that's happening faster and faster. And I think there's probably a good balance for someone like you that's a bit of a trendsetter, disruptor, if you will. But, at the same time, for people to invest in a new product, a new asset class, I think the transparency is helpful. And I think that's some of what I'm doing. So we always welcome the debate. From my perspective, it looks like some of your indices and your portfolios are, risk-based. I want exposure to large caps because I think they're safer. How much of your portfolio construction is based on capturing what you truly believe is alpha versus managing risk? And I think that the portfolio construction process itself and rebalancing are the alpha. To borrow Mark's phrase, the alpha is in the beta, which really just means you want to be exposed to these risk premia long term. And I believe more than ever after the last month that you want to stay invested in this asset class, Bitcoin in particular. But if you miss, a couple of days or a week of the upswing, you miss the whole bounce. So I guess just to rephrase the question and simplify it a little bit, how much of your portfolio construction is really managing risk versus trying to capture risk premia and alpha?
Yeah, it's a healthy blend of both. And the simplest way I can describe what our products are diversified portfolios of crypto assets. The keyword being diversified. A lot of times what you get when you see crypto, the popular crypto asset management firms out there are pretty simplistic or very limited in the scope of assets that they hold. We try, it might be one asset, it might be 10. Our portfolios typically hold about 30 crypto assets, and those 30 assets are differentiated across different crypto sectors intentionally. they have to meet also a certain level of criteria, that we consider to be representative of like fundamental value and have legitimate use cases and all of that. But the idea is we want to offer these diversified holdings across sectors because one, that it just goes back to sort of basic portfolio theory where diversification is the only free lunch. And in theory, over time, that should deliver better risk-adjusted returns than just holding one asset or a small group of assets. So we try to make it really easy to get that broad, diversified exposure off the shelf and into investors' hands at just a very high level. From there, we essentially offer passive versions of that exposure, which is, buy that and hold it at market cap weight, where we offer actively managed versions of that. And it's all actively managed in a sense in that we perform the rebalancing and trading as well. So it's not pure passive, but what we call our active stuff is the factor-driven stuff. And what we're doing there is overweighting assets we like according to our blockchain signals, underweighting the assets we dislike. In terms of how we construct that initial asset universe, though, we do think about it in terms of sectors. So how do we construct portfolios that they're allocated a certain percentage to different sectors, or to your point, different size brackets. We might want, if someone wants a market cap portfolio, essentially, they could get our all cap portfolio, which is 70% allocated approximately to Bitcoin and ETH, the mega caps, 20% to the large caps, so the bracket beneath the megas as we define that, and then 10% to the mid and smaller caps as we define
So
that.
Connor, as you go through this, it helps to do the cap because I think most people and a lot of our audiences, I would say, I don't know what you think, Bill, 60% or higher TradFi, who are using AI for their quant portfolios. Anyway,
I mean, given how
making those-
old we are, yeah, probably.
yeah, traditional, that would be the case, I guess. Back to the Muppets in the balcony, looking down. But hopefully we're not too separated from the realities of opportunity. As you're speaking, Connor, maybe, for the guys in the balcony, make connections as you did to market cap, because we obviously know, people know about cycles and how small caps react versus large caps, and that's all very good. But when you talk about sectors, we understand energy, we understand financials. Can you either make a parallel? Are there 11 major sectors? Are there 2?
Yeah, this is so. I'll start with your first question. Maybe it'd be helpful to talk about what we even mean by like mega, large, and mid. I don't know if that'd be helpful to talk about that, but that's something that is because this asset class is relatively nascent, and the Bitcoin or ETH really the Bitcoin maxis might disagree. It's not necessarily a winner take all game yet, especially for everything beneath Bitcoin. And so what that means is there's a lot of projects and assets in this ecosystem jockeying for market share and investor attention and ultimately customers and users of their protocols. So what that means is the assets move around a lot or can move around a lot. They can jump between mid cap and large cap and fall from large cap to mid cap relatively quickly. And so we define those sizes typically as a percentage of the overall market cap. So in the more traditional asset class or equity world, a lot of times because it's a very stable asset class, the cap sizes are defined sometimes as stocks between this dollar level and that dollar level. So, over 100 billion is a certain market cap. In crypto, or at least as Truvius in our approach, we say large cap is assets that make up at least this percentage of the overall market, or between X percentage and Y percentage of the overall market. So, as the market shrinks and expands, the bracket itself remains relatively stable. I don't know, that's a little bit of a nuanced point, but something that helps us preserve the stability of those brackets. So within our indices, we offer about 30 or so assets. The mega cap index is just 2 assets. It's just Bitcoin and ETH, at least last time I checked. Although that could be changing soon as Ripple, increases in value. Our large cap index is about 10 assets, and the mid cap, kind of the everything else indexes, call it about 15 to 20. So that's how we think about sizes. I can talk a little bit more about that, but I want to get to your sector question, which is, yes, we do try to pattern match to the kind of sector structure that's known to equity. So in the equities world, you have, the BARA sectors or the MSCI sectors where it's, healthcare, financials, information technology, whatever, et cetera. In crypto, we do see similar distinct pillars, similar distinct sectors of the business of digital assets. The commonly known ones, at least for crypto folks, are decentralized finance, smart contract platforms, these sorts of sectors. Other ones might be like metaverse and gaming. Others might be related to payments. But unlike equities, there is no singular governing body that says these are the sectors. There's not one classification or one, governing board that says these are what the sectors are. There's a bunch of people that have tried to come up with that. It's difficult because crypto assets sometimes function as currencies more, sometimes function more like commodities, or sometimes function close to something that could resemble an equity. So they sort of straddle different purposes and use cases. I would say of the people who have attempted to define crypto sectors, there's pretty strong consensus among them. Like I would say they're 0.9, maybe even more correlated if you looked at CoinDesk sectors and Goldman sectors and our sectors as we define them. So I would say there's about 8, Mark, that as we define them. The 8 that we look at are DeFi, smart contract platforms, what we call value transfer, which is more like payments focused.
So stop with DeFi, because that's something I think our listeners hear a lot about, and
yes,
I think is one of the bigger ones, given that you just started with it, unless I'm mistaken.
No, that's exactly right. So, Mark, would it be helpful to kind of explain what DeFi is, or just unpack that sector? Oh, I think you're on mute, Mark.
Maybe compare it back to that tic-tac of traditional. DeFi is, these names, and compare it to the traditional world. Because that's what we're all trying to do, right? Is get behaviors to change to go on chain.
Totally. I think the one for one, if you had to do that, DeFi in crypto would be most akin to financials in the equity world. Maybe you could call it a blend of financials and information technologies, just given its technology aspect. But what DeFi, decentralized finance, essentially means is it's financial services that are occurring on the blockchain or driven by blockchain technology. And a lot of what it's focused on is just removing the middleman from trading or lending markets, or really any sort of markets that bring buyers and sellers together. In the non-blockchain, current real world that we live in, there's tons of middlemen that exist between buyers and sellers, not just in financials, but largely in the financial sector. And DeFi, or decentralized finance, is an innovation occurring, driven by blockchain technology that essentially allows peer-to-peer transactions to occur in a decentralized and what's often called trustless way. So you and I know that we're transacting with each other in a way that's going to work. It's largely safe, and doesn't require us paying fees to someone, just for connecting less, like the bid-ask spread or something like that. So that's DeFi, and again, the one-to-one would be, I think, mostly like financials for equities.
And what percentage of that market do you think that is, of the index?
So I can actually tell you, the way we think about it is we set a strategic allocation to indexes, and it's not perfectly in line with market cap, but just pulling it up here, it makes up about 10% of our overall multi-sector model. So looking at it, breaking it down, the mega cap sort of value transfer and smart contract composition makes up about 70% of the market, which is just true. Those two assets there's not much you can do about that. Those two assets, dominate crypto. And then 30% is like everything else. And DeFi makes up about a third of that everything else.
Yeah. Cool. This is incredibly valuable, I think, for those of us and our listeners who are, getting up to speed with TradFi versus crypto. And we did invite Chris to talk a little bit more today because unfortunately for us, he is our producer and he found a really great job. Connor, you said that some of the more well-known players out there that have crypto products probably don't include companies that like invest in Truvius, for example. You're probably just talking about the BlackRocks and the big players. And then, just a side note, I did speak recently with an RIA that is managing on-chain assets. So they're helping to take care of some of the, additional income you can generate by holding crypto long-term, which is, I could actually ask you a bunch of questions and keep going on and on and on, but I did want to give Chris the floor here to talk to you a little bit more about crypto specific questions. And obviously we want to get to your tax product, but Chris actually wrote a paper on smart contract platforms, and I think he would probably bring a nice informed view of that space.
Yeah, thanks, Bill. Good to talk to everyone again. Connor, great to see you again. One thing I found in doing my research, and you mentioned it a little bit earlier as well, is data. I'm curious, how do you go about collecting data and kind of getting through the discrepancy of different data sources? That was a big issue for me.
Yeah, I'd be curious to learn, Chris, what type of data you're looking at too. But it's gotten better. It used to, to put it plainly, it used to suck. And there's a lot of bad data out there. The data vendor space, in my opinion, has gotten a lot stronger. I would say the big ones that we look at are Token Terminal. Recently, Artemis has kind of come into the fold a little bit, although I'm not sure they meet the same level of depth and breadth that Token Terminal has. There's Santiment, Masari. There's tons of data providers out there that are pulling from blocks, directly off the chain, and they charge a lot of money for it, but there's a lot of value to it. So we're a little bit beholden to, we don't directly source data from the blocks ourselves. We do rely on data vendors to do that. And it's kind of, again, just a process of elbow grease and testing. And in the early days, we would be paying money for a data vendor and they would just send us crazy, wild, bad data every now and then. So we had to, as any quant shop does, you have to build an outlier handling processes and, data backfilling process and all of that. So I don't know if I have like a very fun answer for you, Chris, other than it's a lot of trial and error that's, I think, led us to good data providers. And I think more and better data providers exist today than they did 3 years ago. But I don't know if that's exactly what you're after.
Yeah, no, it was. It was very interesting going to one data source, pulling a report, and then going to another and having completely different answers. Like even on like market cap, you would think those would be pretty solid across those two different data sources. So as Bill mentioned, I'm going to be starting as vice president of research at Galaxy Digital here in a couple of weeks. Thank you very much.
I've heard of them.
So very excited to get going there. For those that don't know, Galaxy is an investment bank. They're a technology play. I think they're the second or third biggest Solana validator in this space, and they have a research team. So I'll be joining the research side of the business. And speaking to the data, I hope that I'm able to kind of take advantage of the massive amounts of data they have coming in their doors every day, and hopefully give you guys a product that you guys can use in the future. That would be really awesome.
That's fantastic. They're a great team, and they're one of the backers of Truvius as well. They're our primary investor. They led our seed round back when we raised a little while back. But they put out excellent research. I recently just read or perused one of their papers on the state of crypto lending. Which is pretty interesting.
It's hot, man. It is. That's a hot topic. At the strategy conference, getting a lot of emails from people saying it's the devil's work. It's the way that Canner's going to grab all your Bitcoin by blowing you up and taking it, and other people saying, thank God, now you don't have to sell your Bitcoin. You can
borrow against it.
Yep. Oh, well, hey, Chris, this is, bittersweet. You were here before I was working with Bill to get us up and running. So totally appreciate all the work in front of and behind the scenes. And let's definitely keep in touch, my friend.
Absolutely. It's been a pleasure, and building something together that people seem to enjoy. So thank you guys, and thanks to all of the listeners as well.
I actually went through the post-production process with Chris last week just to get everything posted, and it was pretty painful for me. Obviously, Chris has an engineering background, so all of this kind of stuff is easier for him. I even posted something on LinkedIn that looked like we were hacked or something. I was trying to make a reference to an old movie, and I'm not sure if anyone understood it, but there was a Good Will Hunting reference in there about someone handing back a difficult problem to someone who really struggles with it, and a few expletives involved. So thank you very much for all the production, Chris. It's been awesome, and obviously we're psyched that you've been able to find your dream job researching crypto. I know that's what we were actually just doing without getting paid for a while together. So that's awesome. Congrats. And then I guess to just shift it back to Connor and, the real reason why he joined today rather than, a few weeks ago, do you want to just tell us about automated tax loss harvesting, what it is, and again, maybe just compare it a little bit to tax loss harvesting equities, for example?
Yeah, definitely. And I'll try to make this quick, or at least, relatively breezy, because I think that people hear the words automated tax loss harvesting and, the lights go out, because it can be a little bit alienating and maybe even boring sounding. But just to orient the conversation, and then I'll get to
just tell people how much money you make doing it and how much everyone needs it. That's how you're going to get this audience growing.
That's exactly right. Well, I don't know if I can say those things, and none of this is tax or investment advice. I forgot to mention that, as Bill correctly pointed out. But there are different ways to invest in anything, and when you talk about taxes, when people think about investing, it's a function of their risk tolerance or their time horizon, sensitivity to fees, their overall asset mix, et cetera. And individuals have different preferences, but generally, I'm generalizing here, you want to maximize returns while minimizing risk. And in other words, you want to hold that tangency portfolio on the classic efficient frontier bullet chart there. And these considerations might then lead you to think about, okay, do I want to invest passively or actively? And are there inefficiencies or mispricing as I should try to outperform, or should I just hold the market? And then from there, you might think about, how do I obtain that exposure? So in other words, like, what types of vehicles should I go after? Should I invest through a private fund or an ETF or an SMA? And right now in the crypto space, the ETF, products are highly limited to mostly single asset passive offerings. Might be good for financial advisors with limited crypto experience and want a simple, low cost first foray into digital assets. But private funds and SMAs, on the other hand, allow for much greater flexibility when it comes to both the asset breadth and selection and the investment strategies. But it's only SMAs, however, that allow customers to actually own the underlying spot crypto assets. And I lay all of that out because this is where tax loss harvesting then enters the picture. So if you recall that, part of investor behavior is seeking to maximize returns and minimize risk. There are different things investment managers can do to toggle each of those components. So for example, if they want to adjust the risk component, they can do things like apply leverage to increase risk or hold more cash to decrease risk. And if they want to interact with the return component of that equation, they can maybe adjust their asset mix depending on which assets, risky assets they hold. And a lot of times this is also where competition comes into play for active management. I have a better investment strategy than you, and et cetera. And tax loss harvesting is this, we think, really cool investment strategy that aims to increase returns or kind of interact with that returns portion of the risk return equation, not by trying to pick assets better or hold them better than the market, that active management kind of investment strategy you typically see and what asset managers typically compete on, but by trying to reduce the amount that you owe in taxes on your investment gains at the end of the year, which essentially allows you to leave more of your wealth invested today, let it compound more, and defer your tax obligations into the future. So that's a mouthful, and maybe like an illustrative example here could be helpful. But the idea is that one of the main pillars or benefits, properties, I should say, of tax loss harvesting is this concept of deferring your taxes, tax deferral, which ultimately just centers around kind of the time value of money, where $1 today, they say is worth more than $1 tomorrow. Same thing is kind of true with taxes. Paying your taxes today is more painful or more costly than if you were to kick it out and pay it tomorrow. So
yeah, and Connor, look at what Bill said. We were saying in 2024, equities were up, in the mid 20s, right? Bill, is kind of how they ended. And now, if you held on, your 12-month gain is 8 or 9%.
Yep.
So if equities revert back, Goldman thinks they are, not just people listen to Goldman more than they do I for some reason, that it's going to be a 3 to 4%, 10-year, I think, kind of return. If you're looking at a single-digit return on equities, hell, managing taxes, which are a 25 to 45% bite, you better be doing that. And so
have to be.
Yep. And that's where I think you're going to be getting, that's why the SMAs work, because you're having high net worth people and large firms come into you to say, I've got people now looking down the road and they'd rather hold on to their stack. Is that, Are there other reasons or?
No, that you're exactly completely spot on. And put aside crypto for a second. What we're seeing today in this heavy, choppy macro environment where stocks sell off 9% in a single day and then rebound the next day, that's like, perfect storm for tax loss harvesting. Because, and this essentially the way it works is, put aside crypto for a second. Let's say you held all 500 stocks in the S&P 500 and you had some Home Depot stock in there and you had some Lowe's stock in there. And let's say your Home Depot stock, falls 5%. What you would do is you would sell the Home Depot stock, realize those losses, and replenish it. That there's in the stock world, you have to replenish it with a similar but different asset. So you would replace it with more Lowe's stock, essentially maintaining your exposure, but you locked in or realized those losses from your Home Depot stock. So now what you can do is use those realized losses to offset your realized gains. And essentially what this does is it minimizes, or whatever you realized in that amount is what you then can use to offset your gains at the end of the year. Now, that might sound too good to be true, and it kind of is, because it's not like you never have to pay those taxes. Because you sold that Home Depot stock and bought more Lowe's, you reestablished a lower cost basis for your Lowe's stock as well. So eventually you'll have to pay, when you go to sell that Lowe's stock at some point in the future, you'll have to pay that tax on it. But what you've done is you've shifted that tax liability into the future. So you've allowed more of your dollars to stay invested today. You've essentially maintained the same exposure kind of synthetically by, swapping out your Home Depot stock with something very similar, and you've kicked out your tax liability into the future. And the benefit, you can sort of quantify that benefit as the longer you kick that tax liability out, and essentially the rate of expected return you'll get on those dollars staying invested. And that the idea is, that's where tax loss harvesting comes in. So it works really well for volatile assets, and this is now where crypto comes in. Crypto is very volatile. Bitcoin can be, or any crypto asset can be down 10% today, up 12% tomorrow. And, it would be kind of foolish in some respects. It's not bulletproof, and there are some cases where tax loss harvesting doesn't make sense for investors. But in those sorts of markets where you can realize losses and then immediately, revert back to your sort of original position, you can use those losses to offset the gains. And even if you don't have any gains, you actually can offset a certain amount of ordinary income as well. Up to $3,000, I think is the limit, which is sort of negligible for high net worth investors, but it's not nothing. So that's kind of the innovation that we're bringing to crypto portfolios, and it's all automated, and it lends itself really well to a systematic approach, because this is very difficult for a single human being to do, or at least can be. And that's why we're excited about bringing this into crypto. And there's some more to it. There's other aspects of tax loss harvesting, like this concept of rate conversion, which is essentially deferring short-term gains to become long-term gains and paying less on those over time. But it all revolves generally around deferring things into the future and using a systematic process to do that. So we're pretty pumped about this, and we're excited to offer this to crypto investors.
Well, that does sound good for investors, but I actually like paying my taxes because I think the government does a good job of spending my money, and I'm not really sure you're doing it. I'm not sure you're really doing a service.
Bill, you're over your sarcasm meter level for the show here. We can't do this. We talked about this offline.
Good for you, Connor. That's the way to be. And yeah, I guess we're starting to run out of time, but I guess, Connor, do you have any observations for us? I think in particular about the TradFi market. I just saw you had a post up about right 2 months ago. I asked whether or not U.S. stock markets are in and positive, why this could be a positive. It's almost like you're claiming to be like a soothsayer, or are you like a asset clairvoyant now? Is that
when I get lucky, I have to announce to the world that I got lucky. People need to know about it. So no, I mean it's I think related to that post, I'd be curious to get both of your perspectives on this, but Mark's in particular, where there's all of this macro volatility going on, and crypto is not insulated from that. And I think this has been an interesting regime in which Bitcoin specifically has benefited from the dollar getting weaker, and this sort of maybe I don't know if you want to call it capital flight, but at least a few weeks ago I think investors were spooked, and we're dumping U.S. stocks and buying into more European stocks as the euro appreciated against the dollar. And I think Bitcoin benefited from that, because Bitcoin has been I think it's up about 3% year to date, whereas a lot of other crypto assets are down way more than that year to date. And I think the main narrative supporting that is a lot of this macro uncertainty is kind of Bitcoin is decoupling a little bit from being a totally risk-on asset to actually being maybe even considered a safe haven or hedge against macro volatility. So I don't know if that's a question or a comment, but it's interesting because it's certainly a departure from, I think, the pure blockchain factor lens that we often look at things through. We look at things over a very long-term time horizon, but in the near term, it's interesting to observe.
Yeah, so that on your blockchain factor, do you ascribe to that kind of kick the first 30 days out approach that usually most factors ascribe to?
Maybe you could explain, Mark, what you mean by that.
When I was at Credit Suisse and we would take our sentiment data and share it with firms, they wanted to have the 5 years to test, and they tested. They say, great, it has dispositive power. We'll use it. And what they would do is it'd be like a lag 1 month, meaning they would use. So if you did that, your model wouldn't even take in April really until until now. So aside from the technical aspect of it, which means that it wouldn't impact your data, the persistence of this, and that's where traditional work comes in. We didn't even get a chance to go into how AI failed me on my Knicks Celtics prediction. My son was right. My AI was way off. It actually hallucinated. It gave me a forward score that was accurate in the game. It gave me a 10 minutes forward score that was accurate for both the Celtics and the Knicks by accident. And then it got the final score, 112-98, wrong. Celtics win, they lost. So as far as what's not in the data, I still ascribe by a fundamental approach, meaning I think this debt dynamic is so strong and persistent. It's like a planetary orb just pulling all sorts of forces its way, like stopping Merz from being chancellor when he already had the majority for the first time since 1944. We've never had an incoming chancellor not garner the vote. Never. You have a lot of, inconceivables, to borrow from the guy at NIDIG who always quotes Princess Bride and that, crazy Sicilian guy. We're having a lot of that. So I think that other people are now looking at a novel, digital, scarce, secure asset and saying maybe a little. So that's a long story of saying I do think it's persistent. It won't be consistent. We're still going to have it sort of gyrate around, but as far as the direction of travel, I like Bitcoin over treasuries, which is what I'm about to hit send on my Substack on, with a link to this podcast.
That's fair. That's great. Yeah. And I don't know if this answers your question, Mark, but we don't like trim out or omit like the last 30 days, for example. Now that I understand your question better, we don't do that, but I think rather than like penalizing, the last 30 days worth of data, what we're looking more towards is there any sort of forward-looking, risk-related data we could look at? So options markets, for example, how can we price in forward-looking signals or use forward-looking signals to price in risk a little bit more? And that exists for Bitcoin and ETH to an extent, a little bit less so for a lot of the other assets we look at. But you're absolutely right, and I'm gonna check out that Substack post when it comes out.
Yeah. Cool. Well, anything else, Mr. Rosa? This is your, swan song here and your launch into the belly of one of the, bigger crypto beasts on the planet.
Yeah, no, it was a fascinating conversation today, Connor. Thanks for joining. Again, excited to be a part of it, and hopefully I'll be a guest on here from the Galaxy side soon.
Nice.
Awesome.
What do you say, Bill?
You're muted, Bill.
Thank you. That should wrap it up. I think this was our first live podcast. So I know that was probably super exciting for you, Connor.
It was.
And, I think you and Chris will hopefully be repeat guests again. We did cover a lot, and I think that I'm still new to some of this, but it seems like when you're investing in crypto, you might dip your toe in by buying an ETF. That's what I did. And then you might get a like Coinbase account. That's what I did. And then eventually I think you do move into the right space, which is actively managing your portfolio. And that might include having a wallet and doing some of this yourself, but I'm actually increasingly of the belief that having someone else systematically invest this for you, and your explanation of tax loss harvesting was actually very good and easy to understand. So I do think it makes a lot of sense to plug your product, and we wish you all the luck with this new this new product, but I have a feeling you're going to be coming on to tell us about, more new things that you're up to. And it seems like my research in crypto, will hopefully continue, even in Chris's absence now. So I'm actually looking forward to continuing to sort of advocate for systematic investing in crypto, and that is in fact what you do. So you're kind of the perfect guest.
Wow. Well, Bill, that means a lot. I'm certainly not going to stop you from doing that. So I appreciate that. Thank you, Bill. And yeah, it does come down to individual investor preferences, but we do try to stay on the bleeding edge of research, and that's the AQR DNA in us, and you share that too. So thanks for that, Bill.
And yeah, so the closing note again is we brought it up last time and then didn't bring it up this time yet. We will ask you about the chief risk officer at AQR, and he was my boss, and that's just such a great story that I hope there's a nice tease in there for our regular listeners that as an intern, I will just say that Connor was traumatized and probably still is to this day. And that's just such a great story. I do hope we get to touch on that next time.
I know you enjoy that a lot, Bill, and I'm happy to relive my trauma.
I would never take joy in another one. It's just such a funny story.
It is. It really is.
But
it's
the senior people did legitimately feel bad for you. I'll say that, and I would like to think I was one of those sympathetic people.
Yeah, sounds like it was from the sidelines, though, Bill. Like, oh yeah.
Well, I worked for this.
That's a day in the life. Yeah.
So I was extremely familiar with this type of behavior and maybe what to say and what not to say. And I've told people that my interview, my first phone interview, was like the meanest I think anyone's ever been to me professionally. And I got off the phone, I was like, oh wow, I really blew that. And then I got called back and ended up taking the job, even though this was and yeah, I don't want to name names or even describe anyone as being mean, but they could come across that way at times. I'll just leave it at that. Awesome. So yeah, I guess Mark, you have any closing words? I'll stop talking.
Yeah, please hit like and subscribe. DM us on any of our work. Bill is usually laden with a lot of research, and most of it is available, and I would say still not fully appreciated, because otherwise we'd be seeing incomings and something having a Bitcoin price given your price predictor. So please hit us up on Harmonic Insights website, my Substack, the macro case for Bitcoin. And if you're in Texas the week of the 19th, give me a heads up. I'll be doing a tour of Houston with Lisa Huff, going to Dallas for the Texas blockchain event the 22nd, and in Austin before that, meeting with endowments. Our calendar is actually filling up, folks. It was a bit of a running in place, but we're getting engagement. People are now wanting to know how to use AI to drive their process, and where does Bitcoin fit into the portfolio. So that's for reals, not just an advertisement. Thanks all. Until next time, take care, folks.
Thank you.